Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, this is John Brackett, your host of We Build Great Apartment Communities. I want to thank you for joining the podcast, joining the show. Today, we have another great guest. His name is Greg Dickerson. Welcome to the show, Greg.
Hey, John, thanks for having me.
Hey, you're very welcome. So I'm going to introduce you to our audience so that they have a pretty good feel for who you are, your background. I always find that that's a great way to start the show, just to invite them into the conversation. And it always helps when people know who they're speaking to. So I'm going to start off. Greg is a serial entrepreneur, real estate developer, coach, and mentor. Okay, he's purchased, developed, and sold over $250 million in real estate, built and renovated hundreds of custom homes and commercial buildings, developed residential and mixed-use subdivisions, and started 12 different companies from the ground up. So Greg is an expert at topics of entrepreneurship, leadership, and real estate, and is regularly interviewed on some of the top real estate investing and business podcasts today. So, hey, I'm glad to have you on the show if that's the case.
Yeah, I'm on one of them today, right?
Exactly. Hey, well, welcome. Really appreciate you being on. You know, we're going through some very unique times right now, and I say that optimistically. Of course, there's some challenge, but I think it's great when you get people on a show like this that have more broad experience in the real estate world, right? In the real estate industry, because it always brings, I think we shed some perspectives that are a little bit more unconventional when we have folks like you on our podcast, on our show. So, Greg, here's my first question, right? We're in an environment right now that's very unique. Changing how business is being done will likely change that moving forward forever. And, you know, one of the things that I find really unique about the situation that we're in right now is, of course, anytime you have challenge, which I'm very empathetic to all of us who are experiencing challenge in this market, but anytime you have challenge, you also have the converse of that, which is opportunity, right? And oftentimes it's just a matter of perspective. So what's your perspective on what opportunity looks like moving forward, maybe for the first 12 months?
So, that's a broad question, but overall, in terms of the economy of the United States, right? We are a global economic leader. We have the largest GDP. We have the most robust economy. The dollar is the reserve currency of the world, and it's going to stay that way. So we're going to rebound. We're going to come back. We're going to return. The question is when and how long does it take to get back to anywhere near where we were from an economic level? So, I still think we're a year, 18 months out to any kind of real recovery in the economy, assuming we get this under control. This is middle of August 2020. So assuming we can get the virus under control, we get vaccines, and more importantly, we get a treatment where we take death off the table when somebody gets infected, then we can talk about real recovery and we can talk about exponential recovery. So we have to get death off the table. We have to get a vaccine going. And what's happening right now is this is the great accelerator. So what COVID has done, there's been a lot of overzealous and abundant credit, easy monetary policy post 2009. Okay. So we've been in that mode since 2009.
Right.
So that's created the ability to be sloppy as an economy. So a lot of bad deals have been done. A lot of easy money's been out there. Companies haven't had to watch the bottom line and watch their numbers and their operations as closely, because whenever they lose money or are facing losses and their burn rate is outpacing their income rate, they can go borrow money. They can issue some debt and go borrow money. And the government is there to shore that up and to make sure that that credit market flows. So we've seen that accelerate. We've seen bad companies get worse. We've seen contraction, of industries that were already in trouble and were already changing before this happened, the retail industry. We're seeing this accelerate that change. We're seeing adaptivity in certain industries, the hotel industry. What the hotel industry is realizing is, wait a minute, we don't have to clean rooms while people are staying anymore. So we can become more efficient. We can eliminate stays. Hot breakfast is something we shouldn't have been doing anyways. We can get rid of that and go back to grab and go. So the hospitality industry is evolving and changing. The Airbnb industry and those types of VRBO, people renting their own properties, that industry is evolving and changing. The airline industry, who knows what's going to happen there. But the one industry that is the mainstay that always has and always will be is housing, right? People need a roof over their head. So housing has largely been unaffected for the most part through all this, other than a lack of supply in single family, somewhat of a lack of supply in multifamily and a lot of attention and a lot of competition for quality assets in the multifamily sector, as well as storage, as well as some industrial. But the opportunities of the way that we're having to adapt, the way that we're having to become more efficient in our operations and in our businesses, it's really interesting how something like this can just accelerate the inevitable.
Right. So I really appreciate you sharing that. So here's something that I find very interesting, right? And you kind of touched on this, which is great, but you talked about post 2009. And what's really interesting, but we don't hear hardly this discussion at all, is from 2008 to 2020, January of lowest unemployment rate in the history of this country, right? But it took us 10 years to create 10 million jobs, okay? 10 years. And unfortunately, in this market, we've lost initially 50 million. Now we're down to 30 million. So I always felt that a good third of the jobs that we actually stabilized to, they're likely not going to come back, right? Just because, to your point, a lot of the things that you talked about in your initial commentary was just evolution, right? And when we evolved, there were some companies that were just not fit to survive in the good times. You run into challenging times and almost inevitable, almost impossible for survival to happen, right? As my neighbor would say, he owns a Chinese restaurant and third generation Japanese restaurant, sushi restaurant, third generation Japanese, right? Father in the war. He looked at me and he goes, "John, this is battle. Okay, it's inevitable. Someone is not going to survive."
Yeah.
And he had a very unique accent when he did that, right? But I never forgot that because it just kind of showed me his mindset. But what are your thoughts on jobs, right? Because I think the big thing that's not talked about is the fact that it took us 10 years to create 10 million jobs. We have 30,000 jobs that are unavailable right now, and we're not going to recreate that in 2, 3, 4 months, even a year, right? So can you talk on that a little bit? And then instead of talking maybe about, I think we all understand that there's going to be challenge there, but where do you see the opportunity coming from that as a result of that void?
So there was too much of everything, too many restaurants, too many retail,
Right.
too much of everything, not enough help. So there's plenty of jobs once we get back open. So what we're missing right now, entertainment industry, hospitality industry, airline industry, discretionary. So discretionary industry at the consumer level is what's largely missing. A little bit of the supply chain that contracted big time March, April, but that's come back to a certain degree. So what you're looking at now is you're looking at the consumer discretionary industry is where the bulk of the jobs have been lost. And that it'll come back with a vengeance in a very fierce way once we get to the point where you can have events again. That's a huge industry where, millions and millions of jobs were lost. Hotel industry, travel industry, all of the food, retail, those types of things. And then all of the jobs that support all that.
Sure.
So it's kind of like you talk about 2009, 2010. It was the construction and real estate industry that took the biggest hit, that all the jobs were lost. So, all of the reverberations through the economy from that, the butterfly effect. So what we're having right now, education, with schools being closed, that's affecting jobs. That's affecting economic activity. The cities where people are working from home, that's affecting economic activities, in and around the cities that are costing jobs. So we have to be able to, number one, get back to work. We have to get back open. We have to be able to have events, have sporting events, have business events, have travel, conferences, hotels, all of that economic activity. Every one of those industries were struggling for help. So the good news is, and the good upside to this is there's going to be a much more abundant and robust labor force ready to go back to work once that, transition happens in the balance, of that virus, of the vaccine and the treatments. Once we get to that point where that's balanced and we know get infected, nothing's going to happen, everything's going to be fine, and you're probably not going to get infected. Once we get through all that, I think that's the net result that creates the biggest opportunity.
It really sounds like the virus is what are your thoughts on this, right? I understand the comments around, making sure that, we can take death off the table. Okay.
That's the key. That's the big one.
You can do that entirely, but I understand the logic there. But how much of that, Greg, do you think is really a confidence driver more than anything else, right? Because if you run up on a hill, okay, and you wave your hand and you say, "Hey, look, once we get this vaccine in place, then now there's a cure. And the expectation is that, people can go back to normal." And this is getting a little bit off topic, but I'll bring it back around. why isn't there a conversation around the underlying issue, which is health, instead of a vaccine? I'm really fascinated by this because you're one of the few people that I've actually talked to that have talked through this cycle this quickly in this much detail. So I'm just very curious to get your perspective on that.
Yeah, so it's kind of like the economy and companies, right? So the government can provide liquidity, but they can't provide solvency. Okay. What the government's doing with monetary easing and fiscal policy is pumping liquidity out there to keep companies alive, but they can't make a bad company good. They can't make
Right.
an unhealthy
Great point. Great point.
economy good,
Great
right?
point.
All they can do is just kind of prop it up. So it's kind of the same thing when you look at from a health standpoint. Okay, all we can really do is number one, stop the bleeding. Okay, so it's triage, right? We're in war. It's triage. You got to stop the bleeding, number one. Then you start searching for, okay, how can we eliminate this thing altogether? So, I'm not a health expert. I'm not an infectious disease expert, but the experts are saying you're never going to get rid of it. So you got to have a vaccine, number one. You got to have a treatment, number two. And what's really interesting is you got the vaccine needs to be long term, right? So there's like a group in the Army that's researching, working on vaccines because these ones that we're talking about now are just kind of short term, like a flu season kind of thing.
Right.
But there's another vaccine that they're working on behind the scenes that's a second phase, that's a long term vaccine that can eliminate a lot of things, maybe even the cold, that they're kind of working on. So the underlying health overall is the big thing. Confidence is key. So if you take death off the table, that's the same thing as what's going on in the government right now and why the markets are where they are. Because the stock market knows death is off the table for us as an industry. We can create financial instruments, put them out there at any price. The federal government's going to buy them. They're not going to let the market fail.
Isn't that
Companies
fascinating?
know that. You've heard zombie companies, right? Zombie companies are companies that their debt and their losses are greater than their income. They know they can create junk bonds and sell them, and the government's going to keep them alive. They've taken death of that company off the table. Boeing is one. They're too big to fail. They know we're not going to die no matter what we do. So that's the same thing that has to happen for every individual. We need to know we can go outside. We don't need a mask. We don't have to worry about it. We get this thing. We get it. We're not going to die. We're not going to be put on a ventilator.
Great analogy and a lot of truth behind that. So let's pivot, right? Let's use our same analogy now and move into the real estate space. So what classes of product do you feel will not die and you're going to be spending your time and energy in, right? What real estate classes do you like moving forward?
Right now, the only three that are survivable of any economic situation, the worst economic conditions we've ever seen, what I call economic Armageddon, which we were almost there, with what happened in March. Housing, that's number one. People have got to have somewhere to live. So if money means nothing and our economy has totally changed and we're back to a barter, type economy,
Right.
Imagine the worst case scenario. You still have something to trade if you own housing. So housing is the safest place, number one. Storage in this environment has managed to sustain, has continued to do well in most economic situations. But if you get to the worst of the worst case, people will sell and or trade their possessions for food, clothing, and shelter.
Correct.
So that could potentially go away. But right now, storage seems to be robust, and that's still a good industry to be in. Of course, warehouse and industrial is doing well. But here's the thing that I want to caution everybody about that. Everybody's jumping into warehousing and last mile distribution and all that kind of stuff. The shopping centers that you talked about, the office buildings you were talking about offline before we started, that's going to become the next warehouse, the next distribution, last mile distribution.
Right.
As we've seen, Amazon's already in talks with, Simon Properties about how can we convert some of these big box stores into an Amazon distribution center. So there's going to be a lot of competition in that space for industrial flex space. A lot of these buildings are going to get repurposed. So, just be on the lookout and be careful for that. But housing, first and foremost, number one, whether it's single family for rent, single family for sale, multifamily for rent, multifamily for sale, that's where it's at. And that's the most resilient asset class that you can be in a real estate cycle right now.
Interesting. So I know there's a lot of discussion right now about build to rent. That seems to be where most of the institutional money is spending their time and energy right now, or at least that's what I'm seeing. I can't say most, but I'm seeing more of that. And so I know with your building background, you probably get exposed to that quite a bit. What are your thoughts on that, right? Because when you talk initially about we're in a market where, we have a constrained supply on product. So in this case, single family residential homes or housing. What do you feel about, or how do you feel about built to rent, especially with
Yeah, it's
housing.
a great trend. A lot of momentum there, and it all started from the financial crisis 2008 and 9, where subdivisions were in default. Banks were taking them back and selling them to, to the REITs and to the investment funds for pennies on the dollar. So that's kind of where that whole model started. There's been a movement since 2008 and 9 towards renting. 30% of the homes and households in the United States are rented. That trend is going to continue to grow. Where does it balance out? I mean, there's some people that still want to own their own home. They don't want to rent. But then there's a majority of the people, or not majority, but a lot of people that would prefer to rent, don't want to own for a lot of different reasons. But either way, especially now, people need a little bit more room. They want a house. They want to have a yard at some point in their life, whether they want to own or rent. That's a huge demand. But yeah, the single family rental model is huge. The problem is it's inefficient and it's expensive. You can't get the per door cost and profitability to the levels that you can with multifamily, because multifamily is a much more efficient vehicle.
Sure.
That's why you see mostly institutional money going into the single family rent, because it's a longer term play. They're banking on a little bit of appreciation. They're just looking for a mild yield in terms of spreads, where you and I are looking for margin.
Yeah. So it's really a yield play for institutional money. It's a yield play, right?
And it's a storehouse. It's a storehouse for wealth, and it's a yield play.
Yeah. Makes a lot of sense. So I'm going to talk a little bit about your background, okay? Because I think you have a pretty unique background, Greg, in that you've touched most asset classes, but you've not only touched them from an investor standpoint, you've also built that product, right? So you've played in that, passively as an operator, and then of course you've built as well. So in this market, okay, I know building is not on anyone's radar. It's not at the top of anyone's radar, but how did you start off in this business? I mean, did you start with construction or did you kind of migrate back to construction? What is the story there? Because it will create more discussion moving forward.
Yeah, so I started in the industry as a small, handyman remodeling contractor, built that into a $30 million company and sold it. And I started a bunch of other businesses along the way. And my philosophy was to build companies that generate cash flow to invest in other assets. So that was my philosophy. That's what I did early on in my young age. So everything I made, when you read off my bio of all those things, that's everything I did with my own personal funds that I generated through the businesses that I own. That's the other half of my story. I'm also an equity capital guy. I like to buy companies, build companies, grow them, scale them, and sell them off. So I'm doing a little more of that now, believe it or not, than real estate at the moment. I've got some really great acquisitions on the table that I'm looking at on the business front. But so that's where I started. So I started remodeling handyman, built that into a building company. Then I started learning how to do development by working for other investors, developers, and then just one thing led to another. And this, so I was local in my geography. So I was broad in my asset type and class, and that's kind of how you have to be. If you're going to be narrowly focused in your geography, you have to expand, your asset class and what you invest in, the types of assets that you invest in. If you're going to be narrow in your focus of the type of assets you invest in, then you got to broaden your geography. So that was just my philosophy. I was in a very small region. A lot of the people that I did deals with and did business with were all developers that were, asset agnostic is what I call it. So we will do any type that makes sense in different areas, so office, retail, multifamily, industrial, whatever it was, and it was just fun. I just did what came along and worked for the opportunities that I found in the areas that they were in.
Yeah, I really like that. I think there's some really good takeaways there. So what were some of the greatest lessons learned that you're actually applying, in this market?
Make sure that there is a market for what you're doing. So when it comes to, when you're a developer, you're creating a product for a market. You're creating something that's going to fill a demand. So first and foremost, you got to understand what's the demand. What's the highest and best use? What's the demand? And, it's not the old build it and they will come. That doesn't always work. Sometimes it does, but it doesn't always work. So you got to be very careful in terms of that. The other thing is you're a pioneer as a developer. You're a visionary. You're a pioneer. You're kind of leading. It's a very difficult business in terms of the criticisms that you receive as a developer. You got to be very thick-skinned because you're bringing progress, and people don't like change. They don't like progress. They don't like trees being torn down. So there's a lot of different things. I'll tell you what's really interesting about being a developer. You're a master craftsman, right? So there's a master carpenter, okay, that can build anything, furniture, trim a house, frame a house, whatever.
Right.
And then there's a trim man who can install doors and casing. Right. Then there's a furniture maker that just makes furniture. Then there's a framer that just frames houses. A master craftsman, a master carpenter can do it all and do it all extremely well. A developer has to be a master of real estate. You have to understand every type of real estate, not only at the level, financial, economic level, at the high level, income and expenses, but what are the parts and pieces that make that up? How does that thing come out of the ground? What does it take to create that? What's the environment in the community, neighborhood, city, county, state look like from a regulatory environment, a political environment? So it's a lot of different things you have to navigate.
Sure.
That's what's really cool about being a developer. You're really a master craftsman.
I like that. I really like that analogy. And yeah, no, I think there's a lot of truth to that. So, in your years of developing product, what has been the greatest success story? Can you share that? Can you walk us through your biggest win and the biggest lesson learned from that?
Yeah, probably, the first thing I ever did as an investor, was flipped a little vacant lot, and I didn't even know. This was back before I even knew what real estate development was, what investing was. A friend of mine was a realtor and he came to me with this little lot and, I had money and he didn't. And he said, look, you put up all the money, we can buy this lot for 100,000 and, I've got somebody that'll buy it for 150. And I was like, can we do that? He said, yeah, absolutely. It's like, okay. So, we did it. I put up all the money. He took care of everything else. 30 days later, we split it. And I was like, I just thought, wow, I didn't even know this was legal, right? Kind of looking around. So that kind of opened my mind up to, the possibilities of what you can do with real estate. And it also taught me that, hey, people want this land. So then what I did was I shifted my focus as a builder. Instead of looking for clients to build houses for, I started looking for great pieces of land that people would want. I tied those up. And then in order to get the land, we had to build a house with me.
Sure.
So I would flip the land to them, make a profit there. Then I would build them a house and make money there. So I started doing that. So in terms of, like deals and launching my career, those were the types of things that I look back on that were really exciting, that really opened up the possibilities of what you can do. And then there's, tons of little things that along the way that are just, amazing stories of deals that just kind of fell in my lap out of nowhere. But I'd say going back to the beginning is probably the most exciting thing because that's when my mind was open to, wow, anything's possible.
I think that's the key, right? Is just once your brain takes hold of the possibility or what's possible in whatever it is that you're doing or whatever industry, then there's now opportunity, right, to move forward. But unless you see the possibility, that opportunity, it's too difficult to grasp. It's not real. And so I really like that. I really like that. So what would be maybe and I'm sure as a developer, you have a couple of these, the biggest challenge or the story that you could share that, instead of the most profitable deal, the least profitable deal, right?
Everything's a challenge, but they've all worked out really well. I've had stuff shift on me. That's the other thing is you have to be nimble and be willing to shift. I was doing this one project, one of my first commercial industrial type projects. I had this gymnastics, trampoline, cheerleading school program. And I had partnered with a guy who was running this program and he was going bankrupt. And he had 75 kids in the program, very small area. We only had like 30,000 year-round residents. So I came in, bought the program, paid off all his debts. He was a great coach, poor businessman. Built out a 10,000 square foot facility, for the gym. So it was gymnastics, trampoline, cheerleading, and took that nonprofit. And then I went and bought a piece of land and I built a 16,000 square foot building that I was going to put them in. And the board decided they didn't want to move. They didn't want to take on the overhead and all that. So I pivoted and I said, well, I'll tell you what, I'm going to go ahead and just sell this thing then. And so I put it on the market. Harley Davidson dealer, from the nearby city came in, bought the building. I built it out for him, became an award-winning dealership. So that was one that was kind of challenging from the standpoint of I bought this property, built this building. They pivoted at the last minute and said, nah, we don't want to move in there. But then it turned out and I created opportunity out of it. And, it turned into a really nice deal, a great property. And I made a ton of money on it. Stuff like that. I had one building that was, it was 3 acres, had an old Golden Corral on it in Virginia Beach that I bought. And I was going to redevelop that into a strip center. And I bought that at the top of the market, paid a premium for it. And, that one didn't do too well. But everything is challenging, but, that's where the opportunities are created, right? Where the challenges are is where opportunities are created, greatness is created. And doing those types of things, doing, subdivision deals where, I can tell you, like I did a 101 lot subdivision in North Carolina. And this deal fell in my lap. It was my engineer was working for a developer. The developer didn't pay his bill. So he gave him the project, in exchange for his bill. It's like $100,000 bill. So he told me about it. So I came in, took it over, And it was through the point, this was a big lesson. Okay, this was a big one here that cost me about 300 grand. I take this project over. It's only 101 lots. It's all designed, ready to go. I'm told it's approved. Everything's ready. It's my engineer telling me this. So I jump in, I take it over. We go to get our final approvals, and I find out that we can't use the clay ductile pipe like we wanted to use for the project or something. I mean, this was a long time ago. And we had to use something else that was going to cost $300,000 more to use because of their code. And I'm like, wait a minute, we're all the way down design.
Right.
It's already gone through the approvals, and now you're telling me we have to switch? And sure enough, we had to do it, and it ended up costing about $300,000 to do it that I had not planned on, in my financials for the project. It had to come
Right.
out of pocket.
Right. So what would you have done differently if you could do that project over again?
Make sure I know exactly where the thing is, what needed to be done, and what the costs were before I jumped in and just bought it and took it over.
Sure.
I just trusted my friend, bought it, just paid him, didn't even check for myself. So that's one of the biggest lessons I've learned through my career as a developer is to always read the code yourself, always ask for, if somebody tells you, well,
That's
this is what the code said, or this is what the requirements are, send me the information so I can review it for myself.
Yeah.
So I've always done that where I review the language myself, because when you're investing and when you're making an investment or doing a development deal, you always want to think like an entrepreneur. And the problem is everybody else in the transaction are, they're employees that are working for entities like a city, a municipality, or another company. So they're not always thinking entrepreneurially. They're not always thinking like every nickel is theirs. They're just checking boxes.
Exactly.
So as an entrepreneur, you got to be creative, and you got to think about, how can I maximize this project, get the most out of this thing with the least amount of time, energy, and effort and money possible, so I can get the highest and best return for myself, investors if you have investors. So whenever there was a challenge or there was some sort of a regulatory issue, I always made sure that I reviewed the information myself from a zoning standpoint, building code standpoint, and materials standpoint, whatever the architects were speccing, things like that. I was working on another project where we were excavating and bulkheading up along a rail line. And, I went in there, and the civil engineer was calling for some sort of a structural concrete detail that wasn't necessary or required. And I challenged him on that thought. He got really upset about it. I brought in another consultant. We ended up eliminating what he was calling for and saved, $400,000 or $500,000, 1 acre site plan. Because, it was just amazing.
Interesting. Yeah. I really like what you said about how you evaluate projects, right? Because most people do not, and I could always tell, when people use these terms, time, energy, money, resources, they have their own money at risk, right? And so it's really interesting to me that that's how you're evaluating projects. So I want to talk a little bit about that, okay? Because I think that's a big one, and it's one that is often never discussed. So I'm going to frame it this way, okay? So Wall Street, they have their own pricing model, right? Capital has a pricing model, okay? Something taught in schools, but what schools don't teach and what that model doesn't include is energy, right? That model accounts for time, it accounts for money, and the whole idea is, how do we price a return, right? What's the risk, and how do we get rewarded for that risk? Well, the big missing element there is a return on energy, okay? There's time, there's money that goes into a project, but people don't often account for a return on energy, which is huge. Because if you're evaluating 5 projects, let's use 3. If you're evaluating 3 projects, okay, one of them is a 100-unit acquisition that you need to reposition. It's a $5 million project. Another one's a $2 million, 50-unit project, right, that you have to purchase, requires less energy. The return's the same as a 100-unit. And then finally, you have a 3-unit project that you can get through in 45 days and make the same amount of money, okay, and say you have $3 million, right? So how do you evaluate that? How do you make a decision? And I think you put it really well, which was time, energy, and then money. Because in some cases, you can do 2 of the 3. You may not want to do 3. You may just want to do 1 and look for better opportunities out there. So talk to me about, how did you develop that, right? Time, energy, and money. How did you develop that model? I call it the experience model for deciding how to place your money.
Yeah, make the most amount of money with the least amount of time, energy, and effort possible. So that's an efficiency calculation. So I was just, I'm just kind of bent that way and wired that way. As an entrepreneur, that's been my business philosophy. That's my thesis. And that works in any industry, any business, any venture, any endeavor. How do you make the most with the least? most amount of money, profit, which is the goal in an enterprise,
That's right.
with the least amount of time, energy, and effort possible. So if you break that down to where you learn that lesson, so I learned that working in restaurants, okay? So when you're in a restaurant and you're managing restaurants and leading and delegating, there's tasks that can be done that you can do yourself, or you can outsource and you can leverage, the time, energy, and effort of others. And then there are certain things that are going to give you the biggest ROI on that time and energy, and there's things that aren't. So when you look at, and learn how to evaluate opportunities, you look at it from the standpoint of where can I spend the least amount of time, energy, and effort? How can I leverage and outsource the talents and abilities of others to reach that goal? So I kind of learned that along the way to where you can identify, man, that's going to take a lot of time on my part. It's going to take a lot of my effort and energy away from other things to do that, especially when you're in the development world, because of the approval process and all the things you have to go through and the hits, that you have to take. So the way I use it is, you want to develop in an area that has an appetite and a mentality for development and is pro-development versus going against the grain. You said something interesting at the beginning. You said, one of the ways to be successful in business is you do the opposite of what everybody else is, right?
That's my philosophy, man. Going the opposite direction of the masses.
You go in the opposite direction. Well, that's great as long as you're not on a one-way road, on a one-way street. If you're on a one-way street, you don't want to be going the opposite direction, okay? It's fine as long as you're on the other side of the road.
It also depends, and again, using your analogy, right? It also depends on time, energy, and of course, resources. So for me, I'll go, okay, I'll take on maybe one project a year where massive time, massive energy commitment, but the upside is massive, right? And so as long as I can mitigate my risk and I feel comfortable taking that upside risk because I can protect my downside, then I'll do it. But it has to be very calculated, and I have to be very confident and comfortable with my assessment of how far I can go to the bottom, right? And if I feel like I can protect my downside risk, then I'll chase the upside. But I don't have $1 billion balance sheet. So I have to be very calculated when I take on those type of projects. And also when I'm working with, investor partner money, and I call them investor partners for a reason, because most of these folks have been with me now for over 10 years, is have to be very calculated because I'm dealing in other people's money as well. But, folks know me now. We're okay if I say, hey, look, here's how we've mitigated this. Typically, if I come to someone with a project, they're waiting for me to identify the downside, the upside, and everyone can make a decision based on that, right? Now, I can't live in that space. I can't make my living in that space, okay? But I can diversify myself, right, into some higher risk projects as long as I can mitigate the downside risk.
And that's the key right there. So what that means, just to break that down even further, the most successful developers, investors are the ones that can accurately calculate risk in financial terms. So when you say mitigate risk, what that means is you're literally breaking it down to a number. If this goes bad and if it goes wrong, this is the number it's going to cost. Yeah. And as long as you can withstand that and you can be okay and it's not going to wipe you out, then that's a risk you can take.
Ideally have at least, 2 exits, right? To completely pay off that cost, as you put it, right?
Exactly. But let's say you can't.
3,
let's say, there's no exit. Your worst case is you got to turn it over. Then there's going to be a number that's going to cost you to do that. Right. So you got to make sure you can withstand that if that were the case. So that's what we're talking about. When you're running a stress test, there is no exit. There is a bottom line when you're assessing risk and calculating risk. This is what it's going to cost me if this fails, then I can't exit, whether it's a company, whether it's a deal. So being able to accurately do that and then understanding the difference between here's the upside, here's the downside, what's that calculation? And then you factor in the energy and effort it takes, risk reward, right?
Right.
So it's a very complicated, it's a very complicated thing that you can't put on paper. It's a gut thing. And that's where, from an investment development standpoint, that's one of the things that you build over the years as a developer is that gut instinct in terms of where your time is best spent. And the other thing is being realistic. So I know you probably know a lot of people that have these lifetime projects that, oh man, this project's going to be so great. They spend their entire life trying to pull this thing together and it never happens.
Right.
And it's like, dude, if you'd have just taken that energy and put it over here, you would have knocked it out of the park. That's where people have to be careful because sometimes you think there's this big upside and there's not. And it could take you 30 years to get there. So you got to look at that. versus what could I have done over here in the interim? I know a lot of people that have fallen into that trap, where they hang on and they hang on and this thing just sucks them dry
Right.
when they could have been doing so much over here. And for whatever reason, they just can't take a little bit here, a little bit here, a little bit here. You did 50 of these versus spending your entire life trying to do this one thing and it never
That one
happened.
home run, huh? That one home.
Yeah.
Yeah. And I really appreciate you commenting on that. In fact, I got into a discussion this morning with a friend of mine that is working on some projects and, same thing, right? It's like, hey, I'm in this one, I'm in this one. John, I want you to be in this one and this one. And in my mind, I'm thinking, man, you've just diluted 60% of my time. And I'm thinking that's just not how I like to invest my time and energy, right? I want to
Yeah.
find things that I know I can do well, that I understand well, that I know the markets, I understand how to price the risk, and I will run after that. But you dilute your time in all these different opportunities, and now you have no opportunity, right? And
Yeah.
so, it's really interesting. I was on a phone conference with a broker. I was looking at buying an apartment building in San Diego. And I'm looking at this thing and I'm assessing the rent roll. It was a small apartment building. 100% of the rent roll was either Section 8 or it was subsidized housing, right? With VA. Well, San Diego, when you think about it, with the new tenant laws that we have in place, and those units, they all needed to be improved, right? So effectively, what was happening is those units were all getting a premium from subsidized housing. The challenge, though, is when we're in a market like this with COVID, the issue now becomes there's a lot of risk associated with government subsidized rents, right? Especially, in California because of what we're going through. And because there have been, and there likely will be a time where government won't be able to pay that. They won't be able to make good on those rents, right? We've already been through that, right? So, I started looking at that and then I go, it's going to take me a lot of time to go in and deal with this issue. And there was already like $20,000 in delinquency against like almost a $300,000 rent roll, right? I mean, it was pretty high. And that's what was shown to me.
Yeah.
So,
Yeah. And you don't know what's coming.
Yeah. Because that was the first thing I said. I said, hey, man, give me a rent roll, break everything down, including delinquency, right? Just so that I'm not wasting time. But, the point there being is what I ended up explaining to this person was, hey, what you're not seeing here, even though I can get through these challenges, you're not pricing this properly because you're not taking into account the embedded risk that's built in to your rents, right? To the government subsidized rents. I'm the one who has to go in and fix that. So effectively, I'd be paying the seller a premium for all the time that I would have to go in and fix all these problems. I said, no, I'm not going to do that.
Yeah.
It's a great analogy, right? Considering what we're talking about right now. And anyways, I end up passing on that. And coincidentally, I got to tell you a funny story. So a friend of mine in the insurance brokerage business sent an article that I'll send to you after this that talks about how NOI right now is being impacted, rising costs, because insurance companies now are saying, you know what? We haven't accounted for the risk in this market. So premiums are going up, okay, which is going to bring valuations down, right? So very, very interesting. And now this is starting to take effect and spread throughout underwriting nationally. And I don't think it's fully creeped in yet, but it's going on right now, especially in high risk markets. I'll send you the article. Very, very interesting article. And they actually quantify the risk. So anyways, I just wanted to comment on that. It's very interesting that we're talking about that. And I underwrote a deal where that was very apparent, right? But everything's a negotiation. Okay, everything's a negotiation. But I don't think that they quite were able to put their hands around that conversation. I'm sure now they have.
Well, and there's still a lot of unsophisticated buyers out there that will buy that and they'll pay a premium because they don't understand those two things. One, the risk premium, insurance going up. Two, the cost to operate those properties are more now with COVID. Right. Because of everything that you have to do, everything administratively, all the way down to the unit level at the complex, your common areas, your office environment, how you turn the units over, how you show them, just everything, how you deal with people. It's costing you more now to operate these properties. So to try to find efficiencies in operations are much more difficult. Expenses are going up. Taxes are going to get everybody. That's the big one that's coming around the pike is that, cities, states, counties are hurting because of what's going on in the economy right now. They've got to make that gap up somehow. So the easiest thing to do is just double everybody's property taxes,
Yeah.
and
So,
the
so
easiest
Greg,
place to,
let me touch on that because man, that is such a great comment. Okay, so I hear a lot of people talking about how they're fleeing to tax-free states, but so you automatically laugh, right? Because you know what's coming. So they're
yeah,
an income tax-free state, but if you look at the property taxes, they're like 3 or 4 times, right? Three and a
right.
half percent, 3%, in some cases almost 4%. So you bring up a great point, right? Folks talk about fleeing to these income tax free states, but yet the government, they have to make up this revenue somehow.
Yeah,
And you're right. One of those key metrics or key areas will be real estate taxes. But
it's the
man,
easiest.
yeah, yeah. So, yeah. And these are the little things that I don't think the market cannot absorb all of these cost increases in a short amount of time. It takes like 12 months, right?
Yeah.
So, what are your thoughts on that? Because I know why you laugh. And I see that.
It
I
might
see
be
that.
tax free today.
Yeah. I see those increases coming. But, talk a little bit about that because that's a great point.
So look, guys, so for everybody that's listening, just like I said, the government can provide liquidity. They cannot provide solvency. Okay. We are, as a nation, going deeper and deeper and deeper into debt. There's deficits, there's holes, there's shortfalls everywhere in every budget at every level that has to be made up some way, somewhere, somehow. Who do you think is going to pay for that? So they can disguise it a lot of different ways. They can advertise it a lot of different ways. At the end of the day, the easiest thing to tax is property because in most areas, you're under taxed for your properties compared to California, New York, New Jersey. When you look at your high property tax areas, you go to some of these other areas, it's ridiculously low. They can double and triple property taxes, and it's not even going to make a dent on a national scale of some of the higher taxed areas. Same thing on sales tax, income tax, all those types of things. States that have no income tax, but guess what? You can tax income, if they need to. They can do a lot of different things. But what we're really talking about overall, what you just said, is price discovery. The issues we're facing right now at this point in the economy of transition that we're going through with everything is price discovery. We don't have any real price discovery in the markets. We don't have any real price discovery in the real estate markets. When I say financial markets, there's no price discovery there. It's out of whack, way out of whack. Everybody knows it. It's all the easy money that's creating inflation at the asset, financial market asset level, bond stocks, gold, those types of things. The real estate market, what you just said, is called price discovery. What's really going on versus what is being asked for certain properties. So we've got a gap there in price discovery, and we're not going to know until we get to the point. And where the real shoe is going to drop is, when the CMBS world and the MBS world starts to feel a little bit of stress and starts to fracture coming into the end of this year, going into next year, and we see some distress, then we might start to see some price discovery. But until we know what are the taxes going to look like, what's our real operational costs going to look like, where are we going moving forward through this cycle and putting COVID behind us, then we can start to get some real price discovery and really know what the long-term impacts are going to be.
All right, great. I really appreciate that. So, last question, in terms of a golden nugget for our audience, based on everything that we talked about, what markets do you like? And we talked about a lot, right? But what markets do you like in asset class?
So geographic,
Yes.
I like the Southeast. So at the end of the day, when you're evaluating markets, if you have positive net migration, everything else is all the other boxes are going to check. Look for positive net migration, meaning more people moving in than moving out. That's a good indicator that you're going to be okay. The areas like you're talking about, a lot of people are fleeing some of these areas to go to these tax havens. That may just be short term in transition. So watch where the people are coming from. The people that are leaving San Francisco, LA, New York, those, and going to these places, I wouldn't be so sure that those places are going to continue to thrive, because once we get things done and we get the civil unrest behind us and we get the virus behind us and people feel safe in cities again, they might just go back because, there's nothing like city life for people that love city life, right? And I used to live in San Diego. It's not city, but San Diego is a city. You just love what you love. You can take the boy out of the city, but you can't take the city out of the boy,
I get it.
So I would watch that, but you want positive net migration. I like the Southeast just from a weather standpoint. I don't like California, because of the regulatory environment. I think the other thing to watch is rent controls in addition to taxes, rent controls and landlord tenant laws. and how that looks moving forward. So you got to watch those areas. So I like the Southeast. There's a lot of population trend there. And in the Southeast, that includes, the mid-Atlantic states, as well as like Tennessee, Alabama, Mississippi, Georgia, South Carolina, those areas, all the way down in Florida, North Carolina, up into the Virginias, the DC area.
Why Mississippi, though? I mean, you touched on a lot of different states, right? Pretty broad geography, but you mentioned Mississippi. Why does Mississippi come to mind as a state that you would, make investment in?
So Mississippi, Alabama, there's a lot of growth going on there. There's a lot of industry in certain cities like Biloxi, Mississippi, Birmingham, Alabama. Those areas are growing. Gulfport, Mississippi, right on the coast. There's some coastal areas of Mississippi that are growing and doing really well. So everybody's thinking about the big markets, the Charlottes, the Atlantas, the LAs, the San Diegos, the San Franciscos, those types of things. When you start getting outside of the big markets where a lot of people are moving, they're moving into these secondary, tertiary markets.
That's right.
So when you're in Mississippi, you're right around, a big area where you've got Tennessee, Mississippi, Alabama, Georgia. There's a lot going on in that area from an industrial standpoint. A lot of people moving to those areas because it's cheap. And, a lot of those areas, like San Antonio, Texas, Austin, well, not San Antonio, but Austin, Texas, modern, very,
well discovered,
urban kind of thing. Yeah. Nashville, Tennessee is kind of going through that. Memphis is kind of going through that. So there's a lot of little areas like that where these little Austin, Texas, type towns are kind of popping up that are sleepy that a lot of people don't know about. So Mississippi is a big one that's really coming around. There's a lot, it's neat in terms of an environment. It's cheap. And there's a lot of jobs around that area. And with people working remote now, people are not only looking at taxes, but they're looking at, man, where's my dollar going to go the furthest?
Right.
I was talking to a friend of mine leaving New Jersey, and he was originally looking at either Arizona or Colorado, and he's going to Nashville. And I'm like, well, where did that come from? That wasn't even on the list. He said, dude, I can get a whole lot for my money there. It's growing. It's got the hip urban thing kind of going on. It's got the country thing going on. Taxes are cheap and you can get a lot of house and land for your money.
Right. No, I'm hearing that conversation quite a bit.
Yeah.
Well,
Mississippi's a sleeper that a lot of people aren't paying attention to.
Interesting. Well, I always love sleeper communities and sleeper market areas. Well, Greg, we are at the end of our conversation. And man, I got to tell you, it's been a great one. Really enjoyed this conversation. I think a lot of value, a lot of nuggets packed into a very condensed conversation. So very unusual, but I think that's the idea, right? Is to find ways to have conversations that are absolutely meaningful, filled with a lot of data, and you've been a tremendous guest. So I want to personally thank you, and I look forward to inviting you back on to learning more about your successes. You've been a tremendous guest. Greg, for people that want to get a hold of you, what would be the best way for them to do that?
So gregdickerson.com is my website. And I've got a YouTube channel, podcast. I put out videos every day. And, especially right now, things are changing day to day, week to week, things like that. So gregdickerson.com, you can find me there. And I'm on social media everywhere.
Okay, great. And Greg, any last questions that you have for me that you think might add some value to our audience?
Yeah. So, you're a developer as well, and you're doing some stuff that's ground up. So why ground up versus continuing on the value add?
Well, this is really a continuation of our strategy about 3 years ago. I mean, I knew that the market was changing. Obviously, no one can really predict exactly when that was going to happen, nor could anyone time what we're going through right now. But I think everybody knew that we were coming to a turning point. And so we had to change our strategy a little bit. San Diego, very competitive market. The yields were going down quite a bit, right? Cap rates were dropping quite a bit. So the strategy was, okay, well, in order for me to pursue higher yielding investments, I'm going to have to take on more risk. Man, I would have to go out of state, right? So the first thing that we had to do there is create a management company, because all things being equal, our greatest risk came down to management, right? I mean, if you're a good operator in San Diego, be a good operator in pretty much any state. But because of the distance, the greatest exposure we had was management. So we had to fix that problem first, which we did. And we took some lumps on some initial investments that we have that are now some of our best performers. But we use those investments really in other states to refine our management company. And so once we dialed that in, the objective was, okay, and I told my team, I said, look, we're going to use this as an opportunity to create a management company where we can operate assets from anywhere in the nation and to do it remotely. So 3 years ago, we were operating remotely. Okay, 3 years ago, we started that quest, building process and systems, and then using people from really different parts of the world, right, to be able to operate remotely and also in different states. So now we've done that. And so when COVID hit, our business didn't change at all. In fact, it just got more competitive. But the idea was to pursue higher yielding investments out of state, right? And we mitigated our risk with better management because initially our management process, it fell down, it broke. So we were really exposed there. So we had to fix that. Now that we have, and then to go into high density markets like San Diego and LA for development projects, right? So to take on more risk with development to increase yield, but also because of the density, I felt that there was less risk doing that, right? Because of the housing constraint or some of the supply issues. So that was the strategy. It still is. It really hasn't changed. I think now we're just in a different environment. That's worked really well for us. And so we're continuing to move forward on that basis. Now we just have to be a little bit more patient. Fortunately, we have projects in our pipeline. We have roughly about 150 units in our pipeline right now, but a lot of that product, low cost basis, right? So it makes sense to still move forward in this market. I think the idea there being is, when everyone's making a left, you make a hard right. So I don't mind going through the planning process, right? The entitlement process, even as long as our basis is low, especially in some of the markets that we're in, like San Diego, it'll take us 14 months to get a project approved or 12, right? If we're lucky. I don't even want to say conservative because in this market, we don't really know what that's going to look like, but say 14 months, say even 16 months. So by the time we're ready to pull permits, right, in theory, construction costs should ease a little bit. And I think that's going to come in the form of, I'm not really looking at labor. I think that's going to start easing too, but the cost to manufacture product, I believe, is going to go way down for some of the reasons we mentioned earlier, right? So for example, when you're in a market where you have an oversupply of labor, okay, the employer at that point is in control, right? Well, when you talk about companies that are manufacturing products that we used to build, they're fairly large companies, right? A lot of influence in the market with employees. So I feel that when that labor cost goes down, it's going to get cheaper to manufacture products to build. And by the time we're ready to build, the hope there being is that, we have a lower cost to build as a result of that. So that's the idea behind construction. But I think in high density markets, you have some really good opportunities for smaller infill product. And there's some opportunity to mitigate your downside risk just because of the supply constraints. And in different states, predominantly for cash flow or higher yielding investments.
Yeah, awesome. Yeah, that's a big question I get all the time and people ask all the time, buy or build?
Yeah. Well, preferably always buy, right?
Yeah.
It's just cheaper, I think, to buy, especially if you're really clear on what your criteria is and you can manage that product well.
That's less risk. You're buying cash flow. So you're buying a business. It's there, it's proven, it's done. Development, it's risk. But, for those of us that develop, it's just, for me, it's how I'm wired. It's what I love to do. It's challenging. I like a challenge.
Yeah.
And at this point in my career, I've been doing this for 20 some years. I know how to calculate the risk accurately and make sure that, like you said, with multiple exits, there's almost no downside. It's,
Right.
if you're doing the right product in the right area, you almost can't fail unless you just way overpay for stuff.
Yeah. Well, that's the other thing I learned over the years, right? Is you always have to respect the cycles. You always have to respect the cycles. And I think in this business, probably one of the greatest gifts is to make sure that you're surrounding yourself by people that have done what I'm trying to do and what I'm doing right now, but that have a huge dose of humility, right? Because when you don't have humility, man, is when you get absolutely crushed, right? You think you can beat the markets. And that's usually when things start going really bad, really fast, but it's almost like a slow burn.
Yeah.
It's a slow burn that accelerates really quickly. And then you're like, well, what just happened? But it didn't happen in 12 months. It happened like over the course of 36.
Yeah. Well, the most important thing to know is the top. It's more important to be able to call the top than the bottom. And nobody ever went broke taking a profit.
Yeah. Or no one ever complained when they didn't lose any money, right? So in other words, not moving forward on something, just being patient. I tell people all the time, hey, I've never heard anyone complain when they didn't lose any money. So just be patient. Just be patient. Things will evolve. Maybe not exactly when you think they should, but they'll show up. And so that's kind of our approach,
Yeah.
So, hey, Greg, thank you so much for being on. Really appreciate the question. Now everybody knows our strategy. But that's what it's all about, right? Hey, look, I'm going to share when I can, and hopefully someone can take a nugget out of this and they can use it to improve what they're doing. But
we can't be everywhere. So yeah, take it and go put it to action and make it happen.
Yeah, that's right. That's right. But hey, thank you again for being such a great guest. Really appreciate the conversation. And man, I wish you continued success.
Yeah, thank you. You too, John.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.